Welcome back, everybody. It's Dr. Trussell here, and since we're having a delay there with the start of the classes, I wanted to get the first class in via the online so you can kind of get a jump on things. When you come in on Wednesday, we will do the second half of Chapter 1. So this is sort of the first half. You can follow along with the class activities that I have put on UTC Learn, and I'm just going to be going through those questions from there. Great to have you back. I look forward to a fantastic semester. Chapter 1 is on the equity method. So in this chapter, we'll discuss the equity method of accounting for equity securities, something that we introduced to you back in Intermediate Accounting 2 in the investments chapter. So we'll extend the discussion that we started in Intermediate 2 to include the excess of the acquisition cost, that's the purchase price, over the book value of the net assets acquired. In other words, we're looking at how much more did you pay for the company than their book value is of their net assets, which is assets minus liabilities. And talking about intercompany sales of inventory. If we buy equity, if we buy stock in another company, what happens when we buy and sell inventory for that from that company? We call that intercompany sales. So those are the three issues that we'll address in this chapter. The first question, accounting for investments, just as sort of a review of the chapter from Intermediate Accounting 2 on investments. We talked about three methods used to account for an investment in equity securities. Those methods are the fair value method, the equity method, and the consolidation method. When do we use each of those? Well, for the fair value method, we use that method when we own less than 20% of a company. We call that that's a 20%. I'm using a mouse here. That is what we call passive investment. What about the equity method? The equity method is when you buy 20 to 50% of the voting stock of another company. That is the equity method. Then finally, we have the consolidation method when we own more than 50% of the company's stock. Now remember, what we're doing is we're buying stock of another company. So why do you think the FASB needs three different methods of accounting for the exact same thing, an equity security? Well, I'll have you ponder that question. We'll talk about that one in class, but why do they need three? Let's review the basics of the equity method, and you actually learned most of this in Intermediate 2. First of all, how is the investment account adjusted during the year for dividends received from the investee? We're the company buying another company. We're called the investor. The company we're investing in is called the investee. What's the investment? Why is the investment account adjusted this way? Well, what do? We decrease the investment for dividends declared. So the journal entry is debit cash, credit the investment. Notice a credit means that we're decreasing the investment account. Why is it we're doing it that way? Because the company is in essence paying us back some of the profits that we've earned. Since we own a significant portion of that company, not control but significant, we are not a passive investor. We have significant influence. They are paying us back our dividends, and so it's reduction of our investment. How is the investment account adjusted during the year for net income earned? Net income earned by the investee, the company we've invested in. And then how about net losses? Well, net income increases the investment account. Net losses decrease the investment account. Why is the investment account just adjusted this way? Again, because what we're doing, since we have significant influence, we are accruing our share of the income or our share of the loss. And so the journal entry is, you see at the end here, debit the investment. What does that do? That increases the investment. And we credit the equity investee income. That's if we have income. If we have a loss, we'll just flip those entries around. Let's go a little bit beyond the basics of the equity method. What happens if you pay more for the company than the book value that you've acquired? What you paid, the cost, what you paid for the investment, if that's greater than the book value of that company. The question is, what's the formula computing goodwill under the equity method? In other words, show how the purchase price, the cost of an investment, is allocated to determine goodwill. So it goes back to our question. The excess of cost of the investment over the book value is allocated. First of all, we take the acquisition price or the cost of the investment. We subtract out the investee book value of their net assets. What do we mean by net assets? Net assets is assets minus liabilities. Net assets. And then we multiply that. Since we didn't buy the whole thing, remember in the equity method we bought between 20 and 50%. So let's say we bought 30%. We didn't buy all the company, so therefore we wouldn't subtract all of the book value. We'll only subtract out our percentage, 30%, 25%, whatever we own. That's going to give us this excess of cost over the book value. This is what we're trying to determine up here. What do we do with that? We allocate it to any under or overvalued assets. All right, so we subtract or add any under or overvalued assets or liabilities, our percentage of them. So let's say that the company, the investee company, has some assets that are undervalued. That means that we were willing to pay more for the company because they had some undervalued assets. So we have some value we see in that. And that difference is goodwill. The tricky part is, though, that we have to amortize that excess of that undervalued asset. So that excess, that is this excess up here, is going to be allocated over its useful life unless it's in goodwill. Now remember, goodwill does not amortize. It might be impaired, but we don't amortize it. So we're only going to amortize it if it's something like a depreciable asset or a patent or a copyright, something that that has a useful life. Here's an example. This is problem 13 from your book. On January 3rd, 2018, Madison Corporation acquired 40%. Let's stop right there. 40%. That's between 20 and 50. That normally means we're going to use the equity method. Of the outstanding common stock of O'Toole Company for, that's the purchase price or the cost. This acquisition gave Madison the ability to exercise significant influence. That's another key language for the use of the equity method over the investee. The book value of the acquired shares. Now this is critical here. They're already adjusting by the percentage we bought because it says the book value of the acquired shares. It didn't say the book value of the whole company. If it tells you the book value of the whole company, then I would have to multiply it by 40%. But they're already telling you they've adjusted it. Any excess of the cost, any excess cost over the underlying book value was assigned to a copyright that was undervalued on its balance sheet. So they're saying the entire amount, the entire excess goes to the copyright. In other words, there's no goodwill in this problem. This copyright has a remaining life of 10 years, so we're going to have to amortize that excess over 10 years. For the year end December 31st, 2018, O'Toole reported net income of $260,000. Now that's for the whole company. We need our percentage of that, and declared cash dividends of $50,000. Again, that's for all stockholders. We only own 40%. At December 31st, 2018, what should Madison report as its investment in O'Toole under the equity method? So they want the balance in the investment account. They're not asking for what portion of income, etc. So there's a process we have to go through. So the first step we have to do is allocate the purchase price as we showed in a couple slides ago. And that we took the acquisition price, or the cost of the investment, subtract out the book value of the acquired shares. Now again, be careful. If they give you the book value of the whole company, then you'd have to multiply it by the 40% we own. But the wording was the book value of the acquired shares. So that excess is $340,000. According to the problem, all of that excess is to be allocated to the undervalued copyright, which means there is no goodwill. Now, the reason why we do this whole process here is because we really need to know this number. Anything in here that's going to be allocated to a depreciable asset or an intangible asset that has a useful life or a definite life, we have to amortize. So according to the problem, we're going to take that $340,000 and allocate it over the 10-year life, or $34,000 per year. We're going to have to amortize that $34,000 a year. So now we can determine the investment balance. Well, we said we're going to start with the beginning balance. What did we say earlier? Net income does what? Net income increases the investment. So I'm going to add in the income, which is $260,000 net income. Don't forget this. We don't own all of the company, so we have to adjust it. And then we subtract the dividends. So it's minus the dividends declared. And again, we don't own all of, so 50,000 dividends times the 40% that we own is 20,000 reduction. And then minus the copyright. And that's going to give us an ending balance of $1,210,000, which the question asks, what's the ending balance in the investment? So that is your answer. So how do we account for the under or overvalued assets? In that problem we just did, there was an undervalued copyright of $340,000. What did we do with it? Well, we amortize it, and then that reduces our share of the income. Remember, we subtracted that out. So therefore, any undervalued assets reduce our share of the income, and any overvalued assets are going to increase our share of the income. And so the journal entry is going to reduce the investment. Notice, just like we said in the previous slide, we're going to reduce the investment, that is, credit the investment. And what does it do? That also decreases our income. This is the income accrual that we made from our investment account. So any undervalued assets reduce the investment and reduce our our income accrual. This account, equity and invested income, is a revenue account, an income account. Our last topic in this chapter is accounting for intercompany sales and purchases. What we mean by this is when the investor purchases or sells inventory to the investee company. So the intercompany, in that we're selling to each other, if you can picture it that way. And we have what's called an upstream sale and a downstream sale. Upstream is when the investee sells to the investor. Now remember, we're always the investor in this case. Downstream sales is when we sell. We, the investor, sell merchandise to the investee. Now, what do we have to do? How do we account for this? Well, the gain on those sales must be deferred. Deferred until when? Deferred until they're sold to a third party. Because otherwise, since we're picking up a share of their gains, if they sell to us something at a gain, well, then we're going to have that gain in our income. But in reality, it's intercompany. That is, they're selling to us, so we can manipulate that by just having them sell us more. So we have to defer the gain until that inventory is then sold to a third party. So what journal entry is made at the end of every period to record the deferral of gains on upstream sales of inventory? So they're selling inventory to us. The investee sells to the investor. We have to defer the gain. Defer until when? Defer until it's sold to a third party. So how do we do that? We debit the equity investee income and credit the investment account. What that does is defer the recognition. Why does that do that? Because remember, those gains are where? They're in the investee's income, and we've already recorded a share of that. Our share of that's already there. So by making this debit to the investee income, we're taking out the gains that we've already recognized in equity pickup that we've recorded. So this defers it. And then what do? Next period, when we sell the goods to an outside party, we're allowed to recognize the gain. So what journal entry is made at the end of every period to record the recognition of previously deferred gains? Those are gains that we deferred last year. Now we're ready to recognize them. What do? We just reverse the entry that we recorded up here. So we're going to credit, reverse that, credit equity investee income and debit the investment account. We're just recognizing the revenue now. How does the accounting differ for downstream sales of inventory versus the upstream ones? Well, the accounting doesn't differ at all, and that's because the gains are there one way or the other, and we need to remove them or defer them. So when we're doing the equity method for that's an investment between 20 and 50% typically. It doesn't matter if it's an upstream or downstream sale, we still need to do the two entries that we just talked about. Let's look at another problem. This is problem 11. Panner Inc. owns 30% of Watkins and applies the equity method. During the current year, they buy inventory costing $54,000, then sells it to Watkins for $90,000. So Panner is selling to Watkins. Well, Panner is the remember this, we're the owner, so we're the investor. We are Panner. Watkins is the investee. So we're selling to Watkins, so that's a downstream sale. It doesn't really matter other than just for terminology's sake. At this point, now we'll see later in consolidations it does matter, but when you're using the equity method, it doesn't matter. So this is a downstream sale. They paid $54,000, then they sold it to Watkins for $90,000. So there's the gain of $36,000. At the end of the year, Watkins still holds $20,000 of the $90,000 that they purchased. They still own $20,000 of it. What amount of unrealized gross profit must they defer in reporting this investment using the equity method? So we have to defer the profit on the $20,000 they haven't sold yet. Remember, once they sell it to a third party, then it doesn't matter. So we only have to worry about the $20,000 that they still hold. What's the gross profit in there? Well, if you remember, gross profit is just going to be your profit divided by your sales. So let's run through the steps. Step 1 is to compute the gross profit rate. Well, gross profit was, remember, sales minus cost of goods sold. So the sales of 90,000 minus the cost of 54,000. And that's your gross profit. Gross profit was 36,000 divided by the sales, which is 90,000, gives you 40% gross profit rate. We're going to multiply that by the 20,000 that's still left in the inventory. Why that? Because the other 70,000 they've already sold. We can recognize that gross profit. We only have to defer gross profit of what we haven't sold yet. So that's going to be $8,000. But remember, that's for the whole company. We don't own the entire company. So then we take that and multiply it by our percentage, which we own 30% of them. And that's going to give you the intra-equity or the intercompany gross profit that we defer. And we do that with the journal entry: debit the equity invested in income and credit the investment in Watkins. So again, we take the gross profit rate times the what's on hand, the inventory still on hand. That gives you the gross profit of this 20,000. And then don't forget this. It's very, very typical to forget this. This 8,000 is gross profit for the entire company. We only own 30% of them, so we only need to defer 30% of the gross profit. So what does the T account look like for the investment account? So this is the investment account. We're going to start with our beginning balance. Of course, it's an asset, so it has a debit. We're going to increase, which is a debit, for the net income of the investee. Don't forget to multiply that by our ownership percentage. That's why I put this percentage sign in, whatever percentage you own. Then we're going to also, any deferred gain that we've realized from previous periods, we're allowed to recognize now. And our credits are going to be that any dividends declared, that reduces our investment. Dividends declared, don't forget the percentage. And then the amortization of the excess, for example, that 34,000 amortization of the copyright, and any deferred gains we're going to is going to reduce our investment. So these are all increases, and these are all these are increases, and over here is our decreases, and that gives us our ending balance in the investment account. It's a good way to think, very good way to analyze things using T accounts. Let's talk about some special accounting procedures related to the equity method. How does the investor account for an investment when significant influence over the investee is achieved through a series of acquisitions? In other words, let's say we bought 10% of the company, 10% of their stock. Then what happens? We would be using the fair value method because we would have passive influence. But then we bought another 15% to give us 25%. So all of a sudden, we're going to need to use the equity method. So basically what we're talking about here is a change from the fair value method to the equity method. And if you remember from intermediate accounting 2, when we have a change in accounting principle, we normally use the retrospective approach. But this is not really a change in principle the same way. It's a change in principle but achieved through the same thing that we're doing, and that is accounting for an investment. So the FASB has actually decided to use the prospective approach here. Prospective means you don't have to go back and adjust anything you've done in previous periods. But from this point forward, that is the point, the day that you bought the number that puts you over 20%, from that point forward, you start using the equity method. How are transactions related to other comprehensive income treated under the equity method? Well, we talked about how net income increases the investment account. Well, what happens if they have other comprehensive income related to to whatever? It could be related to pensions. If you remember pensions, you have that. Well, if they record other comprehensive income, then we need to pick up our share of that, just the same way we record our share of their net income. And finally, how does accounting for the investment under the equity method change if net losses by the investee, that second doesn't need to be there, if net losses by the investee reduce the carrying value investment account to a zero balance? Remember that losses are going to, and dividends both reduce the investment. So if they keep having losses and losses and losses, at some point in time the investment account is going to hit zero. The question is, do we keep reducing the investment so that in essence has a negative balance? And the answer is no. Once you reduce it to zero, you then no longer have to keep accruing for the losses to reduce it below zero. Okay, well that sort of finishes the first half of the chapter. Really a little bit more than that. When you come to class next time, we're going to pick up from here. So go back through those class activities, make sure they're all answered, and come in and we're going to go through a few more problems. So I will see you soon.